Well, after a couple of weeks worth of worry overload, it looks like we are finally back on the mend as of now, as the S&P climbed by almost 2% thus far and still climbing. Now, the real key as an investor is to never allow yourself to panic and sell off because of a little market turbulence, but more importantly, to just invest into high-quality companies for the long-term hold. So today, I have 3 such dividend stock opportunities for you to have your eyes on right now. Ready? Of course, we can get into all the macros to explain all the recent volatility, but I want to leave that for my Sunday video, to which subscribe if you're not already subscribed to the channel for all of your market insights and, of course, brand new dividend stock ideas on a week-to-week basis to kill it this year. However, as for this video, I just want to go CNBC 3-stock lunch on you to actually just share the 3 quality dividend stocks that I have for you to essentially buy now and just forget about, at least until retirement or even beyond retirement, just given the nature of having invested into companies that have strong brand names with clean balance sheets, and that's all then reflected in their industry leadership with great management. With that, first up, I want to talk about Restaurant Brands International, ticker symbol QSR, the restaurant operator for multiple fast food chains like Popeyes, Tim Hortons, and most famously, Burger King. Now, whether it's restaurant brands, McDonald's, Wendy's, or even say more of a dining out type of brand name versus fast food, all of these stocks are actually down as consumer trends shift back to penny pinching, and generally speaking, there has been some price hikes on menus thanks to inflation. However, we shouldn't be fooled nor scared away from investing into these gems because consumers will always, consume, especially when it comes to some of the cheapest dining experiences that you can get with fast food. So grab Restaurant Brands International now, as it recently slid to $73 per share. That's down from about $82 per share months back, and right now it maintains a P under 20. But the power is seen over the long term. If you zoom out, you see over 158% worth of share price appreciation. And while you may be asking, why not just go with, say, a top dog like McDonald's, I say there's a lot of growth potential and power in an underdog investment. Now, analysts agree with me here, forecasting a share price to climb back up to $84.87 per share. It's about 14.9% worth of upside. Now, until then, you're actually also going to invest into a company paying a savory dividend with a yield at 3.14%, 11-year track record with that dividend yield, and more importantly, just growing all along the way. Very fast paced here at a 25% average year-over-year growth rate. Next up, let's go ahead and ditch the fatty burgers and dive right into healthcare with Bristol Myers, ticker symbol BMY, which is one heck of a global big pharma player. And quite frankly, just feeling the pains of all the recent Medicare drug pricing negotiations, as we see the stock now down to about $44 per share not long ago. And overall, it's down on the year by about 11%. But zoom out, you get 20% worth of growth. Not much per se, but then you got to factor in a play like Bristol Myers is all about stability and moreover just about the dividends, which is why I think hedge funds love it, and certainly we can see them scoring more shares worth of Bristol Myers rather recently. While analysts just continue to remain bullish on the stock, with almost 20% worth of upside expected to come to a share price of $53.36. Yet it all comes down to that stability and dividend that I talked about, with a yield at 5.38% that's been making it rain for dividend investors for the last 53 years, all while continuing to climb, not as much as the others again here, but just at a 4% year-over-year growth rate. Now, investors, one more dividend stock to go, but as I mentioned before, I want you to subscribe because I want you on this financial freedom journey with me. There's just so much value that you're going to get from being a part of this community. Moreover, let me know if you're getting value from this video by tapping on that thumbs up button. Now, with that, we're going to get to the last stock here, one that I am most bullish on, and I'm now calling out Home Depot, ticker symbol HD, which is a home improvement retailer that I'm sure you're well aware of, which is the home improvement retailer that leads the industry and will very likely jump right back into the spotlight the moment we get a genuine economic turnaround, whereas interest rates actually start to trickle down, housing prices then come down as well to more affordable ranges, as well as DIY projects picking back up. As you can see, until then, we're just residing in the red at $336 per share, lower PE for Home Depot at 22.4, but thanks to the strong leadership, clean financials, and one heck of a brand name, long-term Home Depot is always a win with almost 440% worth worth of share price appreciation over the last decade, not to mention analysts right now who are remaining steadfast on a recovery to climb back up to $394.65 per share. That's about 17.18% worth of upside. And until then, how about this nice little dividend yield that's been growing? Right now at a yield of 2.67%. However, over the last 36 years, we're going strong with an average growth rate of 19% year over year. Now, investors, there you have them, all three of them. Let me know your thoughts on each dividend stock down in the comments below, or which stocks you think are hot buys right now. Catch more insights right here, or just subscribe to catch all of my latest.